Catherine, how you going? It's been a while since you've joined us. Looking forward to this chat today.
Hi, Greg. Yeah, it has been a while. I've missed you.
We've missed you as well, and we've missed all your insights and your commentary on the land cycle and where we are as we head into the land cycle peak, which we'll get to in the discussion today. But as always, I think it's a good starting point just to explain exactly what the land cycle is and how it affects stock markets, the economy, all that stuff. And obviously, the land cycle is your key analytical point to then look at the rest of the world. So maybe just a brief explanation of what the land cycle is to start with.
Sure. The land cycle is evident in economies that are choreographed around the land market. And what I mean by that is it's economies where they allow land price, people to pocket land price inflation. And then you get all the industries that are kind of built around that. So you get the finance industry and the insurance industry and the furniture making industries and the construction industry. And the reason that, the land market goes up is because the tax policies advantage people that speculate on land. And so you get this cycle of land price inflation. The debts at some point get beyond people's ability to pay, and you get this marked collapse at the end of the cycle. And the cycle, it's not always been evident in the land market in Australia because we've had periods of time where we have not allowed speculation in land. We've had periods of time where we've had very high land taxation. For example, we had a federal land tax between 1911 and 1953, which deterred speculation and hoarding of land and broke up the large squatter estates. And we had rent controls over that period. However, we have had some significant land price collapses in Australia, one in the 1890s, one in the 1930s. And now we correlate with the land cycle that is very evident and works like clockwork in the US. So this is a cycle that you can trace back to when the US started to sell off its land in the late 1700s, around 1800. And every 18 years, through the 18-year period, you get this boom in land values, which averages over around 14 years. It can be a little bit longer, can be a little bit shorter, but on average, it's around a 14-year overall trend of increasing land values, and then a sharp collapse at the end of it. And the cycle was first discovered in its relation to land. An 18-year cycle has often been talked about in its relation to commodity cycles or stock market cycles. You can trace that back further, but it was only really discovered in its relation to land in the 1930s. And there were two authors that released publications at that time. One was Homer Hoyt, who released 100 Years of Land Values in Chicago in 1933, which evidenced what had happened over Chicago's development, massive population growth, a lot of infrastructure investment at the time. And Homer Hoyt, who actually hadn't been a very successful real estate speculator, which was one reason why he wanted to look into it, because he'd made losses on real estate. And he did this for his thesis, wrote this for his thesis. And he recognized that there were these waves of around 18 years where you would get this boom in land values and then a bust at the end of it. And the other chap was Roy Wenslick, who wrote The Coming Boom in Real Estate and What to Do About It in 1936. And he did really a tremendous amount of work on the land cycle. You won't find any information of him online, apart from stuff that I've actually written about him. It's almost like it's been written out of the history books. There's no Wikipedia page. There's no, his books aren't readily available on land like Homer Hoyt's are. But he did a tremendous amount of work on the land cycle. He was employed by insurance companies and banking companies, and he noticed that this wave, this pattern of boom and bust, wasn't just restricted to Chicago, but was in fact happening all over the US. Now, these weren't the only ones. Over the course of the, next decades, there were multiple other economists that recognized a 17/18 year pattern, whether they were looking at construction cycles, whether they were looking at real estate sales. That recognition, it centered around the US, but obviously it was investigated elsewhere. Clarence Long is a name that springs to mind. He was a US politician. And then, of course, we come to the people that we know today. Well, there's a few that have passed on, Mason Gaffney, Fred Foldbury, who were economics professors, and they spoke a lot about the land cycle and this pattern of boom and bust and how to prevent it happening. And the most recent advocate of it, perhaps who's the most famous of all, is Fred Harrison, who's an economist in the UK, and he's written over 20 books, and he discovered the land cycle himself when he took on economics, and has made it his mission really to write about it, and again write how we can stop the land cycle playing havoc with modern economies. Australia now correlates with this cycle. That's the important thing to get across to listeners. You know, it's got a long, lengthy history to it, but Australia correlates with it. And so you can go back to the last land-based led recession in 2008. And okay, we didn't have a full-on collapse, but it you know, that was only because of the stimulus that was pumped into the economy. We'll remember it as the GFC. America called it the Great Recession, the worst recession since the Great Depression. Go back 18 years from 2008, you get back to the next land-based led recession, which was in the early 1990s, 1991, the recession we had to have, Keating era. You go back 18 years from there, you get back to 1973, 74, very, very bad commercial land crash. Go back 18 years from there, you get back to the early 1950s, not so bad because it was a period post the World War II, and so there hadn't been as much speculation in land, so there wasn't a boom and there couldn't be such a massive bust. But you know, and then in our land price collapses, you know, at the end of the 1890s and the 1930s and the 1840s, they also correlated with this 18-year cyclical pattern. So when our land prices collapse, they happen against this pattern. And so the important thing to understand is, because our economy is choreographed around the land market, because we're so dependent on land price inflation for multiple industries to thrive, when you get a land price collapse, it's extremely important to know that timing, because you can make a lot of money in the boom, but you're also going to be wiped out in the bust, you and the economy. So it's important to understand it from an investment perspective, but also from a moral perspective, it's important to understand the havoc it can wreak on economies.
When I was first learning about the land cycle many years ago, I think one of the things that resonated with me was when it was probably you who explained it, something along the lines of the land takes the gains from economic expansion. So when uh, stock market's going up, people cashing out of the stock market, they're investing in land. When infrastructure is built, the land around that infrastructure gains in value. So the land takes the gains in all forms of economic expansion. And I think for me, that was almost the trigger point of understanding how this land cycle was linked to economics, which was linked to the stock market. What I find interesting in the whole thing is how, like you were just talking about, these advocates for wanting to stop the land cycle and maybe stop the volatility that goes on with stock markets and economics, not necessarily stop the volatility, but to maybe create a more equitable system, never get listened to. And but there are people out there who understand this. And I flicked onto I was watching some YouTube videos just this week, and out of the blue, up comes you know, the standard YouTube ad, and of course it was a property ad, and a property spruiker was saying between 2024 and 2027, Australian property is going to boom. And I immediately thought, okay, he understands about this second half of the property cycle. So maybe let's just turn to the Aussie market, because I think for many people, they're looking at Australian property and thinking it's insane. Our young kids can't get into the property market in anywhere, I guess, in inner city areas. It's very difficult to get in without two-income households. You need to take on massive amounts of debts. Interest rates have gone up over the past few years. Property prices have continued to go up, whereas a lot of people think higher borrowing costs means lower house prices. So maybe just explain how the Aussie property market can potentially continue to go up for another 3 years, despite all these seeming headwinds that are facing it.
It's the core understanding of what you started with there, which is, you know, land price takes the gains, or, you know, the all benefits in the economy end up in the land price. And the reason for that was there was a acronym that was used by Mason Gaffney, who was he passed away over COVID, but he was the one of the US economists that I mentioned that looked into the land cycle, and it's called ATCOR, all taxes come out of rent. And in when we talk about rent in economics terms, it's economic rent, so it's basically land price inflation, those gains that you get for no work, whereas your wage and your productivity is through the sweat of your brow. When your land
Yep.
price goes up, it's because of everything that happens around it. And it can be understood really in a very basic way by understanding that we have an abundance of land in Australia. However, there's only so much of it that is well facilitated to attract demand, basically in the capital cities and mostly on the East Coast. So in those capitals, they've got the best schools, they've got the best shopping strips, they've got where all the high paying jobs are. Even with the work from home situation, people need to be close to facilities and networks and the things that make life worth living, and topographical features like the bay. And so because there's only so much well facilitated land, and we have quite rapid population growth, it means that there's a fight for the best seats in town, which is where you find the land cycle is evident best. And so if you get a situation in the economy as we have now with tax cuts on income tax, it means that people have got more money, therefore they can borrow more, which means that they can bid up the price of land. And as land price goes up, it benefits those that own the land,
Yep.
and that's where the tax system dictates that we should put our investment, because the tax system benefits landowners over everything else. So because we all need land and we all have to compete in that market, it means that most of our incomes really, if you're a renter, generally speaking, or a mortgage holder, goes on your land. If you've paid off your mortgage, then a lot of your investment and a lot of your retirement savings or your fund is built into your land price. And that's really why it takes the gains of the economy. If we have an economy that's doing well, you'll see it in the land price. The land price will go up. And if we have an economic bust, then obviously that leaves people less money to bid up the price of land. And that's basically the concept of how land takes the gains in the economy. And it belies everybody. I was doing a podcast the other day talking about how when we're looking at the land cycle, sure, we have to look at fundamentals, because when we're looking at cycles, no two cycles play out the same way. So we have to take into account, what interest rates are going, what's happening with the cash rate, the lending rates, what the tax system is doing, how much have we got to pay extra land tax this year, have we got population growth, all of those things factor into it. But it seems by the regularity of this pattern that there is a cycle by which you can forecast the timing against. And if you don't take into account that there is a cycle, if you refuse to believe that there are economic cycles where you can time, despite the hundreds of years of evidence that we've now got with the land cycle that shows that this happens when you allow speculation on land in areas of limited supply. You won't find it in areas where there's heaps of supply and there's no speculation. But if we can understand that, then we have to look at both. And if you don't look at both, then you're going to be forecasting like a weather forecaster. And that is, interest rates have gone up, and therefore that's going to impact land prices. One of the reasons that the land cycle continues is because of these economic gains, because we have the collapse, there's banking regulation that's implemented, economies start to recover. In the first half of this cycle, we saw that recovery happening between around mid-2012 to 2017, a bit of the pullback for the Royal Commission, and then obviously a boom into when COVID happened, a bit of a scare and then a boom. But because all those gains have been made, they're gains that people pull against. They give people extra money, and that's what enables the second half of the cycle to sort of roll on, is the gains that people made through those periods of boom time. So even though a higher cash rate or higher lending rates can have an impact on buyers and spook them a little bit, ultimately we're not at the point where the economy is going to crash. We'll get there, but there's a timing element to it.
Yep.
So if you don't understand that timing, then you're going to make these calls too early. And we've seen it. Gosh, I mean, they had 60 minutes. I think it was 60 minutes program the other day. One of my subscribers alerted me to it, where Harry Dent was on, the program. And you've had Harry Dent on promotions that you've done at Fat Tail. I mean, I'm sure he would be aware of the cycle, but he's always forecasting a crash. I mean, he's famous for forecasting accurately the 2008 crisis, but they say it was accurate. He was actually 2 years early doing it. And if you
Yeah.
understand the land cycle, you never would have made a 2 year inaccuracy on it. You wouldn't have made a call like he did in 2005. So I tend to look at both. When you look at both, you're not going to make these calls sort of out of the timing of it. But ultimately, because land takes the gains in the economy, that you see that cycle continue until it does get to that point where the debts become too high for people to pay, and then you will get the collapse at the end of it.
Well, I think with perma bears like Harry, they're going to be right once in 18 years at least. So he'll get there eventually. What I was going to ask about is what's going on in Melbourne. This is your hometown. Melbourne, for anyone who lives in Victoria, Melbourne, they understand that they haven't really participated in this sort of more recent upswing that we've seen in Sydney, that you've pointed out, in Brisbane, especially Perth and Adelaide, that have done very well over the past couple of years. But Melbourne's got a very high net migration benefit, but not very friendly political or tax jurisdiction. Would that be fair to say? I mean, I moved from Melbourne during the COVID lockdown, and we talked about this a lot. Melbourneites were very harshly dealt with around that time. The government was an absolute disaster, racked up huge amounts of debts, and I think that's probably weighing on things a little bit now. So even though the broader cycle can play out across the country, there are areas that it does have an effect on, depending on those specific circumstances. Can you just maybe talk a little bit about Melbourne, how it hasn't participated, and what you maybe expect for it in the next couple of years?
Yeah, for sure. I mean, Melbourne is everything that you said, obviously, is accurate. We were really hammered hard over that COVID lockdown. It felt like we were locked down for almost 2 years. And then, of course, we had all the vaccine mandates, which also impacted economic activity following the lockdown. And then, of course, the government now is in huge debt, and they're fighting to get themselves back into a better financial position. And they're doing so really through, they've increase in taxes, obviously, but one of the main places that they've increased it is on land taxation. And this really should be evidence of how good land tax is at stopping the cycle. Because as soon as you start to take away those gains each year through
There's
an
no
increase
incentive.
that impacts the capital gains, because it's coming out of your ultimate capital gains. But once you're paying higher payments, it makes it less profitable to hoard land. It makes it less profitable to hold land out of use. And of course, it's not just increase in land tax that we've had. We're also now seeing legislation go through, which is threatening to put regulation around Airbnbs. We've seen a windfall gains tax, which is preventing developers from benefiting from the uplift of zoning changes, which is always built into the profits that developers get. The developers think, well, that's kind of built into our profit. If we can't benefit from that, it's will we develop? So we're getting a slowdown in that kind of
Can I
activity.
ask, as someone who advocates for tax reform in this area, what are your views on these changes? Have they been done in the right way, or is it just an ill considered grab to try to fill some holes that they've dug in the budget?
Well, obviously, I'm president of Prosper Australia. I'm not talking as president of Prosper Australia when I'm talking about this. Prosper
Yep.
Australia is a Georgist organisation, and I am a Georgist. And Georgist is a special form of economics, which is based on the teachings and the advocacy, I should say, of Henry George. But his advocacy wasn't really any different to the advocacy of many classical economists that had come before him. He was just a very inspiring man who captured people's imagination, because he was able to talk about these tax changes that we advocate in a way that the ordinary man understood. So what I would say, what we try and do at Prosper is we try and shift taxation off productivity, which is the income that you earn, so labour wages and productivity, and put them onto the income that you don't earn. But in understanding that, I would say that we're an anti-tax organisation, because tax to me is robbery. Tax is robbing people's incomes
Yep.
to pay for as they spruik that tax is used to pay for services, but to pay for community services. Whereas the land tax is arguably shouldn't be called a tax. It should be a collection of the increase in land price, which is due to those community services around it. So
Yep.
it's like a collection of, as Fred Harrison puts it, a collection of the rent. But because the rent is a difficult term, because people think, oh, you're talking about rent, I have to pay rent.
Yeah.
It's the economic rent. It's just the land price inflation. So a collection of that through a land tax. It's like, well, your price has gone up so much percent this year. That means that we're going to tax it so much percent, which will reduce speculation. But if you're a very successful shop owner or in the service industry and you own that block of land and you have a very successful business and you're not being taxed to death on your personal income, then it may not be a problem for you to pay that community charge. And a lot of people are coming around to this concept now. I mean, I was interested over the last few years to see Warren Mosler, who's the modern monetary creator of modern monetary theory, but rather the one who explained really how the monetary system works and talks about how we can get a better understanding of that rather than thinking that we have to pay taxes, but which we do because it stimulates, it gives money its value, it gives the national currency its value. But he's now advocating a single tax on property, not on land, but on property. So it makes a lot of sense. What I would say is I'm anti-tax. I don't want to pay any tax. I don't want to have to pay high, as we were talking just before we started recording.
No one wants to pay
High bills to the tax man and to my accountant, to go through my income tax payments. We should have economies really that lean in the direction of Georgism far more than they do. And, we can look to Singapore for one that does. The speaker at our annual dinner, the annual Henry George commemorative address that we do each year, was from Singapore this year. An economist from Singapore, we flew her over to explain to us how they managed to have such low income taxes there, how they have a over 90% home ownership rate, and really a very successful economy, which with enormous GDP gains, because their economy leans in that direction. And that's what Australia should do. Australia's land, its residential land, its commercial land, and its mineral wealth, which is also land, is our greatest community asset. We shouldn't have to pay high taxes because we're the lucky country with so much commonwealth that should be shared with all of us, through sovereign wealth funds and whatever.
So going back to Melbourne, do you think that's the worst is over for its property slump? I mean, from what I've read, it really hasn't done too much over the past couple of years, while the rest of the country's property cycle has continued to head north. Do you think the worst is over there, or do you think it's got more to go?
Yeah, I think it's really interesting that that we're talking about it really, because that pullback at some point it's going to be priced in. And we've seen that, in a pullback in values, there hasn't really been any uplift in values for quite a long period of time now, to the point that Melbourne's market is now being advocated in the media as being relatively affordable compared to what's happening in other states. We're seeing Brisbane's median price almost exceed Melbourne's now. If you remember in the last cycle, when we got to around 2006, that was spooked about Sydney, Perth. Perth's median price exceeded Sydney's for a very short period of time. So we're seeing the smaller capitals by population are doing exceedingly well. A lot of speculation, a lot of people have been pulled in that direction. A lot of investment has been pulled in that direction, and Melbourne is deterring investment. And at some point, it's going to be priced in, and at some point, we're going to see the wheel turn, and that could happen over 2025. It's not happening at the moment, but what is interesting about Melbourne's market is it has a larger percentage of first home buyers compared to other areas of Australia. So you could argue, I mean, this is almost the best argument for a land tax. Take away the speculation, it opens it up more up to a home buying market. Of course, we don't implement a land tax on homeowners or a capital gains tax. So it makes sense when the market is becoming more affordable and
Yep.
you're not intending on moving for a period of time to stop paying rent and to get into the market. And that's those are all natural things that we would expect to see in Melbourne. Now, Melbourne also has enormous population growth. We're not seeing any reduction in the amount of migrants that are coming in, both, particularly from overseas. And those migrants, even though they come in as students or whatever else, eventually become permanent residents, and a good proportion of them become citizens, and that will keep pressure on the areas in Melbourne where most people want to live. So we can expect at some point the market will turn.
Yep.
And I would have thought if it's going to turn in this cycle, it will be through 2025, and it'll either be a mild turn, or we'll see a little bit more of an uplift, probably more of a mild turn than speculating that Melbourne's going to boom. But it's not happening yet, but I expect that it could happen at some point.
And so before I do want to talk about how this all relates to financial markets, equity markets in the US and obviously in Australia. But before we get to that, I just want to sort of finish on the Australian property cycle. And I started this conversation by saying the property ad I saw on YouTube was saying from 24 to 27, property is going to boom in Australia. Is that roughly how you're seeing it for people here who might be speculating in property, investing in property, developing? What are you saying in terms of where they should be looking at peak prices roughly? And I know that there's always a bit of wiggle room on either side when we're talking about an 18-year cycle, but what's your thoughts on that as we sit here in mid 24?
Mm. Um, it's I think I know the advert that he's talking about that talks about that boom happening. The peak, typically, when we're timing the peak of the land cycle isn't too difficult to time. It's typically 14 years from the point at which prices start to turn. And if we look at what happened after the 2008 downturn, well, we had a first home buyers grant, so it was a bit of a false start, and that petered out as soon as the grant was taken away. So really, apart from the bit of inflation that we had with that grant, it took until sort of mid 2012 for prices to make a sustained turn on their own through just general improvements in the economy. And if we come 14 years from there, it brings us to mid 2026, which is where I'm still sort of forecasting that the market will reach its peak. Now, because Australia is a relatively small country population-wise, the median can kind of filter upwards after that, and so we've seen in previous land cycles, unlike countries that have a much larger population, that in certain areas of Australia, the land price peak. I mean, the land price peak in the GFC, whereas all economies were sort of collapsing when the stock market went in October 2007, Australia's median land price continued to increase into 2008. It was really in 2008 that we really felt the bottom go out of the land market, and a lot of real estate agents, lost their businesses and incomes over that period of time until that stimulus was put into the economy. So I would say that we're still looking around 2026. I would not want to be buying, at any point into the land market as we're coming up to that peak, unless it is your plan to hold on for the next 10 years. Because what we normally see in Melbourne is that Melbourne has a very strong first half to the cycle. If government incentives are put into the economy when that point of collapse comes, that can certainly mitigate the losses. And if you try and speculate via the cycle, and as people did really in 2007, they thought, okay, we'll offload anybody that knew this cycle. I know a few people that sort of offloaded their properties at that time, only to realize by 2010 their property values had exceeded where they were in 2007 due to the stimulus that was pumped in by the government. So, a lot of things really depend on how you want to play this cycle, investment wise. But yeah, I mean, I wouldn't want to be, if you're planning on selling at the peak of this cycle, I would still say you've got to aim for that sort of mid 2026 point.
Yep. All right, so let's turn to the equity market and how the property cycle has an effect on the equity market. I was reading some of your recent writings, and we were talking about, or you were writing about, how there are cycles within cycles, and the years ending have certain characteristics. So let's start with the years ending in 2024 tend to be bearish years. We've had a pretty good year this year. I mean, it hasn't been a disaster. It hasn't been hugely bullish. We did see a bit of a very sharp correction in July, August, just a few weeks ago, but the market's now bounced back to all-time highs. So what are you expecting for the rest of 2024? I know there's a lot of concern that we are sort of moving into recession. Higher interest rates are starting to impact the economy. How do you see the market playing out in relation to the cycle just for this year? And then we'll get on to 2025 in a minute.
Yeah. Do you want me to give a bit of background on that year ending in four,
Sure.
people that don't understand it?
Mhm.
Um, yeah, so obviously the equity market holds a lot of economic rent. It holds a lot of land value in it. Even on a company, asset base, a lot of that would be made of their land holdings. If we're not talking about the banking industry and the mining industry and the building companies and development companies and everything. So we need to understand that the stock market broadly follows that cycle, and so we have to keep the period of time in the cycle in mind. We should, by the time we get to 2028, be in a recession. We should really be in a recession. I would expect America to be in recession anywhere between around post-August 2026 to the end of 2027, America should be entering recession. So we need to keep that in mind, because that's going to have a significant impact on the stock market, no matter what other cycles say. Land prices go, stock market's going to go. And the collapse at the end, it has this kind of like three peaks to the land cycle. What happens in the median price in property, what happens to the commodity market, but the real reactionary one is when the stock market goes, and that's the point that actually is pretty difficult to time, obviously.
Yep.
Otherwise, I wouldn't be sitting here writing. I'd be somewhere else. So the way that we kind of look a little bit closer at the stock market is to use the decade cycle. And the decade cycle, again, it is actually more of a 20-year cycle than it is a 10-year cycle. But a lot of people have noticed a decade cycle in the equity markets. It probably started with Charles Dow, that when he set up the DJI, he noticed that around every decade there was a recession in every decade. And then he did see patterns that were occurring. And, in certain years of the decade, you would see a certain pattern playing out. So often, the market could bottom in a year ending in a 0 or a 1. When we get to a year ending in a 5, the market kind of really seems to take off. There's a sharp correction in a year ending in a 7. Markets often peak out in a year ending in a 9. Those theories were expanded on by a few people, probably the most famous of which was W.D. Gann, who wrote a lot on the decade cycle. And it was based on this idea that if you have a look at the stock market chart for what happened in years ending in 1, and the Dow is used mostly for this because it's got the longest historical record.
Yep.
There's a kind of similar pattern that plays out in all years ending in 1 and all years ending in 2 and all years ending in 3. And then if you look at certain significant time periods that are very relevant, 20 years, 60 years, 90 years, and you start to see what happened in those years, and then you also use a bit of knowledge about the land cycle, you can kind of work out when the pullbacks are going to come during the year. So, if you looked at that pattern for a year ending in 4, for example, you would have seen that it was possible to have a bit of a sharp pullback between July and August. The trend for the rest of the year should be broadly up, and then when we get to years ending in 5, what's really significant about that, and it's been again noticed by multiple people that, famous traders on the stock market, who have realized that years ending in 5, you don't really get a collapse in a year ending in 5. In fact, the year ending in 5, as termed by Gann, was the year of ascension. And so it typically, over that historical period, years ending in 5 have seen the most gains. And of course, as we know, a year ending in 5 is this bullish year in relation to the land cycle. So the land cycle being that 18-year period from low to low, you have around 14 years of rising land prices. And then the last couple of years in the land cycle tends to be very strong. In Australia, it exhibits more over the last year than it does over a 2-year period, which is, Fred Harrison coined the name of this period. He coined it the winner's curse, because it's the time where you think you've won, but really you get cursed because you're right on the brink of a downturn. Actually, I don't think the winner's curse as a phrase, sort of dates back a little bit before that, but he always said, okay, this period is the winner's curse. In Australia, it's more of a 1-year period. So we had very strong gains through 2007, not so much 2006, collapse into 2008. Very strong gains in 1989, more so than 1988, then a collapse into obviously the early 1990s. So if we're speculating that the peak of the land cycle should come, around 2006, we would expect 2025, or at least by mid 2025, to be a very strong year, showing very strong gains in land price inflation. But because we know this decade cycle is also impacting and playing into it, then we would also be forecasting that's going to be a very strong year as per the decade cycle. Now, this is arguably why all the other recessionary indicators that are flashing red at the moment are going wrong. We've got the yield curve that's been inverted since, around, I think it's in July 2020.
2022, yeah.
Yeah. But then, I mean, and then people have said, okay, well, that's manipulation, quantitative easing, manipulation of rates and everything that's keeping that down. And that's probably why the period has been longer. I mean, it's still signaling that we've got a recession ahead, which is, we have got a recession ahead. It's just that the timing's wrong. If you
It's
just
going to
look
be
at
a few years longer than what people expect.
If you just look at that indicator alone based on its history, the timing is a bit inaccurate. And then, there was a bit of huffle and puffle around the SAM index, SAHM, who was named after someone who used to work for the Federal Reserve, which is based on unemployment, a bit of an uptick in
Yep.
unemployment compared to what it was a year before. And that's never been wrong, in calling a recession. But even the author of that, I think she came out and said, well, it could be wrong this time because of these things that are happening in the economy. But
Well, if you use the rule that whenever something becomes popular, it ceases to work, then I don't think it's going to work this time, because there was a moment at the start of August where nearly everyone was talking about the SAM rule, the SAM indicator. Everyone from mainstream news to blog posts, everyone was talking about it. So it's not going to work.
Yeah, that's right. Well, I mean, the way I sort of saw it is, you've got to kind of, I just feel that because once you understand how the land market impacts the economy, and once you understand that there's a pretty set cycle in that land cycle, and okay, you can be a little bit out on the timing, but generally speaking, well, Fred Harrison, I mean, he's arguably the most successful economic forecaster because he's now in, sorry, Fred, if I've got this wrong, but he's now in his 80s, approaching what he wants to retire and kick back. But he's been forecasting recessions incredibly accurately per timing, the mid-cycle recession, because there's always a recession that doesn't impact land around the mid of that 18 years. And then, of course, you get the one at the end of the 14-year uprise.
Yep.
But he's never been wrong. I mean, we should be talking about him rather than Harry Dent. But that's the indicator that you really need to look at, because that's the one that sits like, as I learned it, gravity to the economy, because we need land so much. So what we've got at the moment is everything that's kind of stimulating the land markets. We've got Kamala, who I think will win based on the cycles that I look at. But, it's not necessarily my advocacy. But,
I mean, it's a disaster whoever wins, but I'm
is
not
it
sure
just...
which is the bigger disaster, maybe. Yeah, we'll see.
I lived in the States for a while. I lived through an election in the States, so I've got a little bit of understand. But it's like watching something happen on another planet, watching their election campaigns, and it's just unbelievable. And I'm actually talking to someone who knows Trump at the moment. I've been trying to get been having a chat with him, but about the land cycle. I'm thinking, oh, that'd be good if you can talk about it with Trump.
He's a property man. Hey, I was going to ask you, in relation to Australia and 2025 potentially being a strong year, how do you think about China when you're thinking about that? Because I guess one of the real headwinds to Australia for the last 12 months has been this slowdown in China's property market. And I know you probably can't equate China's property market in the same way that you equate Western property markets, but purely from an economic perspective, that has weighed on Australia's growth through lackluster performance of many commodities. We've seen iron ore prices in the news lately, falling below $100 US a barrel. Just generally, commodity sentiment has been quite poor. So, do you think about China in this respect, and how that might sort of play out over the next 6 to 12 months?
Just to finish that last thought, because it kind of ties into it. We've got Kamala with her, I'm going to give you a first home buyers grant if I get in. We've got the Fed's reducing rates. So there's a lot of things that are going on,
Yeah.
the economy. But interestingly enough, if we bring commodities into it, we are seeing the biggest build out of physical assets in human history post the COVID recession, which couldn't have been a more impactful recession on this land cycle in particular, because of the migration patterns and because of the spending that was built into it to pull economies out of recession. All of that, a vast majority of that went into infrastructure payments. And so America has record infrastructure spend. The UK has a record infrastructure spend. And of course, China's been building its Belt and Road for a number of years. And that is a huge project. On top of that, we have multiple countries that are competing for the world's tallest. Obviously we have the Middle East, which is always, the oil wealth and everything is one of the leading contenders. But we also have areas in Asia now where they're building very tall buildings. We have some of the tallest, skinniest skyscraper that's been built in New York. All of these things require a huge amount of mineral wealth. And then if you add on to that this obsession for net zero, then you have the conversations that I hear quite commonly. Being president of Prosper, talked to a lot of politicians, was talking to a strategic planner the other day in New South Wales who said, we do not have enough gravel in the state to build the infrastructure that we need, because they're having big mining companies knocking on the door saying we need so much land for wind farms. Now, that is part of another cycle. It's part of the land cycle, but a land cycle that spans over a longer period of time, which is the Kondratieff cycle, which explains a lot of what we're seeing right now in that kind of dynamic. And the Kondratieff cycle is around 25 years up of rising prices in commodities and around 25 years down, without going into a huge amount of the history of it.
And where are we at the moment in relation to that cycle? Because if you speak to most people who are invested in commodities, and personally, I've recommended many. I guess I'm overweight energy, whether that's coal, natural gas, oil. I think they're really solid long-term areas to be in. But right now, the market's completely disagreeing and saying marking those prices down, the share prices are in the toilet. And you can say that across the board for many commodities, especially at the junior end. There's not a lot of capital going into the sector. So what's the Kondratieff wave pointing to there? And how do you sort of square that circle, given that we're potentially in a bullish wave for commodities, yet you're not seeing that in terms of prices?
I mean, I suspect that could turn around next year as well, because what we typically see towards the end of the land cycle is, those commodities taken off, such as copper and, iron. We normally see that pattern. I guess you have to take the fundamentals of what's happening into account. For not seeing it now. But the Kondratieff cycle, I mean, it doesn't mean that you don't get pullbacks through that inflationary wave. So the inflationary wave that we're seeing now, sort of coming from the, early 2000s, should take us around to a peak at the same time as the land cycle, the end of this decade, really. And then and it's an inflation in terms of inflation in the economies, inflation in commodity prices. We know that the demand is there. So it's really only, in my mind, a case of time before we see that demand play out in the price. I mean, we need to take into account what's happening, in WA and mines closing down and everything. I feel a little bit like, how does it play out in the local economy is when you look at the fundamentals. I mean, if we didn't, if we were just forecasting the land cycle, we would say we would never have forecast such a sharp rise in the cash rate so early on in the second half of the cycle. We see it happening in the second half of the cycle, but more so that intense rise happens towards the end of it. So, looking at the fundamentals is really important. I don't think it's shifted the timing, though, of this cycle. I don't think that it's made much difference in that respect. So
just to be clear, I was going to say the Kondratieff cycle started in 2000, and you expected to peak around the same time as the land cycle, which that would make for a powerful peak then, right? Whether we've got two sort of cycles in unison going into a peak.
Absolutely, around 2001. Yeah, and the other thing that's really evident that I was going to come to with China, it's really worth looking at the Kondratieff cycle, because I think we look at the land cycle and kind of ignore that there's a backdrop to it, because the Kondratieff cycle is all about new innovation. You know, you can trace this cycle through the canals, through the steam engine, through the rise of electricity, and it's got a very interesting history behind it. And once you see the pattern, you know, again, you realize that the overall trend is up. It doesn't mean that you're not going to get, you know, a pullback, but the other thing that's really interesting about this cycle is because commodities are, you know, essentially the fuel of empires, and because the new technology, which right now is all tied up with, you know, the move to net zero, electric cars, you know, we're seeing this new wave of energy production, which is as we would expect per that cycle. Then the commodities needed to fuel that particular transition are the ones that are most in demand, outside of the normal ones that are used for construction, you know, such as sand, concrete, you know, silica sand and everything. And so based on that, what you get at the peak of the Kondratieff wave is war. Unequivocally, you get war, and war over the essential trade lines, which is what China has been setting itself up for, arguably, with the Belt and Road and what's going on in the South China Sea, because that's where its lifeline is. So it needs command over those trade routes. And of course, what we're seeing with the war in Europe between Russia and Ukraine is arguably the same dynamic, you know, with the mineral wealth that Ukraine holds. And then we've got what's happening in the Middle East, which is really an Iranian war. It's not got an awful lot to do, because Hamas is Iran's proxy, which is fighting to control the supply lines into the Middle East. And this is where the central banks, if you're going to sort of look at this from a land cycle perspective, you could argue, well, this is kind of where they're going wrong, because we've still got significant supply problems. We've got ships that are adding extra time onto their shipping routes. We've still got things that are playing into the inflationary dynamic, which have got a fire under them and are ready to go off. In the Middle East, this isn't about free
Well,
free an area of land in the Middle East. This is about minerals and the wealth of those. And so I think that we will see war escalate. Now, arguably, it's not going to be World War III until China gets involved, but that has been one of my forecasts. And I've been talking to some people that are far more intelligent on this subject than I am, you know, such as David Murrin in the UK, who's very good at understanding the geopolitical dynamics that are playing behind it.
let
But
me
I think
let me
it's
throw a sorry, I'll let you finish that point.
well, that's the biggest risk, really, in terms of, you know, you're talking about the China dynamic. I think China's got a bigger plan that it's playing underneath all of this. I mean, we can look at its land market, but honestly, we don't really know what's going on in China's land market. We don't have an awful lot of information about, you know, they've got the power really to spend their way out of certain problems in the land market. It's also, when Chinese people buy, they have to have a very high deposit in order to buy. And I know we've seen development companies collapse where everybody was saying, okay, this is it, this is the end, you know, this is the end of Australia, but it hasn't been the end of Australia. It hasn't produced the things that we would expect it to produce. And I think this is where you need to understand how the land cycle works and the timing of it, because you know, we make these rash calls based on what we're seeing in the headlines, and we're not necessarily seeing the whole picture of what's going on underneath that. So I think China's got a little bit of a bigger game plan that it's playing out here, which could catch everybody by surprise as we reach the peak of this land cycle. And if it does, it wouldn't catch those people that look at the Kondratieff cycle by surprise, because it's understood that at the peak of that cycle, you can have wars that can be quite significant. If they play out in a local area, then it won't impact us so much with the following cycle. But if this current war does escalate into something more, then there's every possibility that it could impact investment into land markets in the following cycle.
So with all that in mind, it just made me think of some stuff that I've been talking about and writing about for quite some time. You sort of talked about the commodity intensiveness of this new wave of energy that we're trying to produce, and it's very energy intensive, but ultimately it's very energy inefficient as well. And I wonder where you were talking about with the flashpoints there in Russia, Ukraine, the Middle East, all very traditionally energy rich areas. So how do you think about, and one thing that we didn't mention is AI and being a new form of, in the way that you mentioned canals, electricity, it's a new technological development that if you believe the advocates for AI, it's going to change the world in the same way the internet did. AI is very, very energy intensive as well. So from what I'm sort of piecing together is that we are investing, you know, hundreds of billions of dollars in trying to transform our economy into a low carbon economy, which is very inefficient spending because we're not getting the energy return on energy investment, and we're under investing in traditional high productive forms of energy. Do you see, and just to sort of go on to the China point, a lot of stuff that a lot of renewable advocates will point to China and say they're investing a huge amount in renewables. They're on board with the net zero concept. But people who really know what's going on say China's just trying to diversify its energy sources. It doesn't want to rely on the Middle East completely. It doesn't want to rely on the US, which is now the largest energy producer in the world. So I'm just wondering if you can make a few comments trying to tie all this together. We're putting huge amounts of resources into inefficient energy. We're forgetting about real energy. And at the end of the day, this world is all about real energy. And if there is a coming war over resources, surely that is going to be over energy resources.
Hmm. Yeah, I agree just with just about everything that you've said there. But I think what's also important to understand that once we get past that peak, and it could be a real inflationary peak, and it could push, to 2030. I mean, there's nothing to say that it couldn't sort of get us there, particularly if we have war at the peak. I mean, war came at the peak in World War One of the land cycle and completely disrupted everything. It disrupted it so much that it actually shifted the land cycle at that
Yep.
point. So, we know that there could be massive disruption of what we're seeing in economies. And we know that it has a lot to do with energy markets. But if we also take that cycle into account, we know that on the down wave of a Kondratieff cycle is where you see the build out of that once that infrastructure has been built out. So once we've reached some of those targets, which are 2030 targets, there's not the intensity of demand for as much building activity to build the infrastructure out. AI has come in and perhaps we've worked out what's useful about it and what's not useful about it. I mean, technology happens so quickly now. A year isn't a long time in terms of technological advancement.
Yep.
That and we're also seeing this kind of play out towards the peak of this cycle where we're seeing capital cities empty. And what I mean by that is not, obviously Australia's a very small country, so I'm not talking about all the capitals, but I think it's interesting in this work from home dynamic, which has really only just started to take hold, even though we've had the internet for quite a long period of time. COVID advanced that. Now we're going into AI, which is shifting how businesses work, putting a lot of businesses out of business, with making that kind of software very affordable to a lot of people. We're going into an inflationary, not a deflationary period in terms of land prices, where the inflation in the economy is. It's completely ignored by CPA data, but it's the land price inflation that impacts the economy most, because as the shopkeeper has to pay higher rents and higher prices for land, it means you've got less money for productive investment and productive activity to employ people. And so
Mhm.
as we hit that kind of deflationary, okay, all of this has played out, perhaps we're moving outwards again from the capital cities. Perhaps the migration patterns are changing, the demand on minerals is changing. Then arguably we're not going to have such an inflationary episode in the next cycle. Now, I'm not a fortune teller. I can't tell. I can only do the timing on this based on the history. But I
Yep.
would expect that, post-war or post whatever's going to happen at the end of this decade, uh, we're going to see those dynamics change the pattern of land markets and potentially see it play out in a bit of a different way over the next 2-3 cycles. I mean, certainly the Kondratieff period is basically 3 land cycles that it sort of plays out over. Yeah, but I mean, I think our biggest, I think we're really foolish if we don't look at what's happening globally at the moment in terms of an energy perspective. If we don't look at these wars from an energy perspective and see what could potentially impact investment from that, because that's what we know. You know, anyone that's been around a bit, you understand that that's what war is about. Um, Access to land and its commodities. If
Yep.
we don't understand how it's impacting the supply lines and understand that countries are going to get involved if they feel that their supply lines are going to be under threat, or their allies are going to be under threat that enables their economies to thrive, then we're missing a big piece of the puzzle here. And I think that that's the biggest threat that we're seeing in this land cycle. I don't necessarily think it's all just going to dissipate away over the next few years. It could.
Well, that was the classic, Japanese attack on Pearl Harbor, right? The Americans cut off their, or threatened to cut off their supply of oil, so they had a preemptive strike to try to stop that. It's always about commodities and energy, as you say, and land. Where I'm just conscious of time. We're coming up to an hour. Maybe last question. Uh, you spoke at the start of the interview how what causes the cycle to turn, or what causes the economic damage from the cycle turning, is when land prices fall below the value that, say, banks or financial institutions hold that land value on their balance sheets. And effectively, what that does is destroy shareholder equity, which then turns the whole cycle. And that's what triggered off the last credit bust, especially in the US, with the huge amount of leverage that went on in property there. Um, is there any sort of theories or ideas you have about how this particular cycle might play out, or does it happen in a similar way across all cycles?
Yeah, I think it's always the unexpected that kind of triggers it, and I don't know what that unexpected could be. I mean, whether it's an uncovering of mortgage fraud, such as it was in the savings and loans crisis and the subprime crisis, or whether it's something else that's going to trigger it. You know, I mean, the Wall Street stock market collapse was never seen as a land price collapse, but it was, and the same with the OPEC oil spike. I mean, I
When
can
you say the Wall Street collapse, which era were you talking about there?
I'm
Back
talking
in
about the Great Depression in the
30s. Yeah.
30s. It's always seen as, there was too much speculation on Wall Street and a lot of ignoring over what was happening in the land markets. But we know that that was a huge bubble in Florida in
Yeah.
the lead up to the peak. And of course, because again, land is the most valuable thing that we have. We derive all our sustenance from it: food, water, air, safety, everything,
Yep.
Uh, because of that, that's where the gains go. That's, the gains on the stock market get eaten back up into the land market, and one feeds the other. And what you get at the end of the cycle is a financial collapse. That's the banks that have, and we're seeing it start now, that start to loosen their finance conditions. But when the land prices drop below the loaned funds in the bank, is where you're heading into a financial crisis. So you always, and of course, there's always that possibility of a run on a bank at the
Yep.
slightest sign of it. And that is a very typical feature at the end of the land cycle. And we've seen it in Australia. We saw it in the 1990s, the number of banks that closed when we had that collapse. And, we have a very monopolistic banking system. I can't think of the word that I was trying to
Oligopoly.
yeah, that's right. Yeah, very concentrated. I mean, so we're kind of primed up for it in a way. Now, if you don't owe anything on your land and you can afford to hold over that downturn, and you've but perhaps the most common question I get is the fear over what's going to happen. I mean, is your money safe in the bank? Is your money, if it's not safe in land, it's not safe in the stock market, because the stock market's going to go. Is it safe in the bank because of, you've got more than the deposit guarantees? Because the once your money is in the bank, it doesn't really belong to you. It belongs to the
Absolutely.
banking
Yeah.
system. So, understanding how to play this cycle is actually pretty tricky. I mean, knowing it is one thing, and you can make money out of knowing it, but you can easily lose a lot of money, even though you do know it, because you're not quite sure how it's going to play out, in the economy. And so it requires a lot of diversification, a lot of understanding, being wary of the peak, making sure that if you do hold, what you want to do is get rid of your poor assets in the land market. Holding on to good quality land, you can speculate that as long as you're in an area which is going to attract population growth, and Sydney and Melbourne are the two biggest, most diversified cities in
Yep.
Australia that attract that population growth. If you've got a really good block of land in any of those areas where you've got that consistent, solid demand, then when the economy recovers, your land price is going to recover, and arguably, the peaks are going to be exceeded. But I think that's the interesting aspect about this cycle is everything that we've just been discussing. How are the migration patterns going to change with the new technology pushed through?
Yep.
Are we going to have more concentrated cities because the governments are going to say, well, we need to, reduce, we've got problems with climate, so everybody needs to live walkable distance and in high-rise accommodation. Are we going to see the reverse, where people want to get as far away from cities as they can in government control and go and invest out in regional WA, which I've actually seen a trend towards over the last few years. Is a lot of my subscribers. I say a lot, it's probably a bit of it's the ones that I hear from, quite a few that I've heard from, quite a percentage.
Enough for it to be a thing.
Yeah, they want to, they are getting ready for retirement. They're selling up, and they want to be as self-sustainable as possible, whether that be a caravan or whether that be a home in regional WA, where they're far away and they're self-sustaining and they can all live there as a family unit, and they don't have to worry too much about what's happening in the cities.
Final question. The stock market is often seen as a leading indicator, but if I think back to the last cycle, there were plenty of indications that the physical property market was topping out in 2006. Yet the stock market didn't top out until 2007, and then began falling sort of late 2007, I should say, began falling more dramatically in 2008. In fact, I just wrote something to members just recently saying that in 2007, in July and August, we had a 12% correction, and then the market went and rallied 25% into a late November 2007 peak. So just wondering what your sort of thoughts were on the stock market being a leading indicator for this property cycle, or whether it's actually a lagging indicator. And I ask that because if we're thinking about a property market peak in 2026, mid 2026, roughly, if we're thinking about a very strong market in 2025, should we be seeing a peak in 2025 in the market as being the peak for the cycle, i.e. preempting the property market peak, or would the stock market continue to rally, do you think, into 2026?
At the moment, my forecast is that it would continue to rally into 2026. But if we're looking for leading indicators, and that's just based on, looking at the decade cycle, and I'm also been going through a lot of the old financial timetables and looking at how they've been correlated, and the work of Samuel Benner and everything, to see what they were looking at, because they were incredibly accurate in their forecasting. But so that's sort of based on what I'm looking at the moment. But the leading indicators, you have to look at the US, and this is why it's important not to ignore US data, because the US obviously is a much bigger economy. So leading indicators are far more evident, and those ones that lead in the stock market are the home building companies mostly. The home more so, I think, even so than the REITs. So you've got the
The
REITs,
ones that have got the land on their balance sheets effectively,
Mm.
right? Yeah.
The developers, the ones that are building and developing, they're kind of sit at the forefront of the cycle, because what's happening in the land cycle is kind of like the fragments at the end of the land cycle is when they can't suddenly make the sales. I mean, we've seen, a fair bit of it this cycle in a lot of development companies going into administration, but because there's other stuff that's playing out. But in the US, the home building companies and the development companies are, when I last looked, at 2-3 weeks ago when I was writing about it, but they're still doing really well. I mean,
Yep.
they're still roaring up there. And so when we start to see them peak out, and we're realizing that on the ground they're not selling the homes anymore, that there's not the buying demand there anymore, that they're making losses, and we start to see those fragments along with where it needs to happen in the timing of the land cycle. So not early on, when we see it, but
Yep.
around that kind of pivotal time that we know rules markets, then that's where we think, okay, we're having a few leading indicators now that we really are well and truly approaching that peak point, and you need to make your plans. I think picking it on the stock market, when the stock market is sort of very reactionary, and those people that really want to try and pick the peak can do that. I'm not sure that's going to be me, but the problem with the land market is if you're going to sell, then you have to plan a sale. And the reason that I say that is because I remember, even though I say that the median price carried on rising in Australia into 2008, the heat had gone well out of the market into there. I mean, whatever was selling, it could have just been the way that, a few high-end sales that were pushing that medium still to go a little bit higher, or a lag in the data collection or something. But, the bottom went out of the market. There's a big difference when you've got 3 or 4 people that are interested in buying your home to when you've got one buyer and the economy is clearly going through problems. So even though we can see a peak after the stock market peak, if you're going to sell your land, you need to be prepared well in advance when the market's roaring. And there's indicators, there's very good real estate indicators that will indicate that,
Yep.
shortage of stock, high demand, high clearance rates in the area where you're looking, very, very low vacancy rates. We're seeing a little bit of a change to that now. We're seeing vacancy rates start to tick up a little bit. We're seeing like a tiny bit of a pullback in rent. So that we're starting, to sort of see that at a point where, okay, 2025 could still be strong, but we're starting to see those kind of fragments coming now as we're approaching the peak. We need to take notice of them.
Yep. Awesome stuff, Catherine. Really fascinating conversation. But for people who want to follow you and find out more, tell us where they can find you, mate.
Sure. They can find me at landcycleinvestor.com.
All right. Thank you so much for joining us. Really enjoyed the conversation, and we'll catch up again in well, at least before the end of the year.
Sounds good. Thanks, Greg.
All right. Thanks, Catherine. And thank you so much for listening, and we'll see you again soon.